One of the items that we will be talking about throughout the semester is capacity management for our businesses. So what we've been looking at is that we have budgeted activity consumption of 12,500 hours. So we have different levels of capacity. Our practical capacity is the actual use of our capacity under regular normal situations. Our budgeted capacity is what we actually think the budgeted consumption of that is. Then we have two other types of capacity that we'll talk about in future chapters, but they're usually under if we had perfect situations, how many hours of capacity would we have for our staff? So if our staff never stopped working across an 8-hour period, no lunch breaks, no anything, no downtime, what would that capacity look like? So if we switch our activity consumption from budgeted hours to practical capacity of 15,625 hours, we would change our activity consumption rate to $8 per engineering hour instead of the original rate of $10 per engineering hour, which then reduces the amount of cost that gets spread onto our products because it's being spread across a higher number of hours. When we're looking at capacity, one of the reasons that we want to look at capacity is what capacity do we have to increase our attention to some products. So if you'll remember in the previous portion of this example, they were trying to decide if they should spend more marketing attention on their AW product line or their SZ product line. They decided that they were going to spend more attention to their SC product line. Knowing what their capacity is and knowing that they have the ability to increase their capacity still by several hours means they could increase their production of the SCCC product line if there was an increased demand for it. So when we use those practical capacity hours, we're going to reduce the amount of overhead by $2. That total reduction in overhead is $25,000. That $25,000 refers to the cost of our unused or idle capacity. That means that by not using that extra capacity, we're losing $25,000. If we produced up to the level of that practical capacity, we have the potential to make another $25,000, which because we've increased production. Now, manufacturing to fit capacity is not always the best idea. We should only consider it if we have the demand for the product. So if we manufacture to meet capacity, but there's no demand for our product, then we end up losing money anyway because we end up with stagnant product that is sitting around not being sold. So we have to strategically think about how we use that idle capacity and what we do with it. The next thing Chapter 5 talks about is activity-based management. So how we apply the theories and thoughts behind activity-based costing to the management of our company. When we're looking at activity-based management, we're looking to improve the value of the products or services that we provide. Because if we have increased value of product and services, we increase our firm's competitiveness and profitability. We can improve our value to our current customers and show potential customers that we have greater value. When we're looking for activity-based management and strategy, we're looking to focus the efficiency of our key businesses, processes, and activities. So we want to be looking at ways that we can improve our current processes and activities. So we have two different categories of activity-based management. We have operational and strategic. So the operational focuses on our daily activities, our operational efficiency, our asset utilization, and looking to lower the cost of doing what we're doing in our operations. For strategy, we're looking to alter the demand for certain activities and to increase profitability through improved activity efficiency. So one, we want to look at what all of our activities are, and we might find that some of those activities are non-value added, then we want to reduce those, and we want to increase the value added activities. And all of our activities we're going to want to make more efficient. We do activity analysis just like in activity-based costing. We assess each activity after we've made a list of our activities. We assess those activities based on what is needed by the product or the customer, how efficient that activity is, and its value content. Does it add value or not add value? In our value added analysis, we want to identify and eliminate activities that add little or no value to the customer. Resource consumption then can be reduced, which helps to reduce our costs. When we're using less resources on non-value added activities, then we can increase the amount of time and energy for activities that increase our customer satisfaction. Examples of non-value added activities are the time that we spend reworking things that were made incorrectly in the first place. So the customer doesn't want to pay for time that we spend fixing products that were not made correctly. They want us to make products correctly the first time and have high quality standards. High value added activities are things that significantly increase the value of the product or service. What things are customers looking for in that product or service? Can we increase the quality of the materials or components that we're using in those items? What items contribute to our customer satisfaction? Maybe having extra colors of a product line or extra customization possibilities. These high value added activities are critical steps in our production and business process. So removal of any one of these activities would reduce the value of the product or service to our customers. Low value added activities consume time and resources and/or space, but do little or nothing to add to our customer demands and our needs. They can be eliminated without affecting the product or service. Sometimes when we find these low value added activities, we have to find what is causing them and then create strategies to eliminate them. For one, a low value added activity is extra time spent making something with possible rework. In that case, how we eliminate that time is by training our employees. So the more skilled and the more training our employees receive, the less possibility that they're going to create products that need rework. And it's going to take them less time to make quality products as they become more efficient. So that is one of the ways that we can eliminate a low value added activity. Beyond our products and services, we can use activity-based costing and management to estimate our customer-related costs. And therefore, we can look at the profitability of our customers. Then we can decide if it's worth it to keep those customers or not. Customer profitability analysis looks at the service activities and cost drivers that we provide each customer. This helps us choose if we want to go after other customers, if we want to do whatever we can to keep the customers we have, it helps us decide what discounts and sales we might want to offer those customers. If we want to have a customer plan where the more you buy, the bigger a discount you get, or you could get points or rewards. Maybe it also helps us decide if there are cross-sale opportunities for customers. So if they're already a customer and buying one product, what can we do to start them buying other products within our product line? So when we're doing customer cost analysis, first we look at those activities and cost drivers that we use to service customers before and after sales. We have customer-related costs. We have unit-level costs. So these are the resources consumed for each unit sold to a customer. Sales commissions, shipping costs, package costs, invoicing. Then we have customer batch level costs. So these are the resources consumed for each sales transaction. So maybe a customer ordered 10 products on a transaction. And then our customer sustaining costs. These are our marketing emails, monthly statement processing. If we allow credit purchases, then we have collection costs for late payments. If we have a reward system, what things do we do to keep those customers after they've already purchased a product so that they come back and purchase from us a second time? We also have the distribution channel costs. So we have a centralized distribution center, or we might have a regional warehouse. Then we have costs associated with that. A good example of that is Amazon, who has created more centralized distribution centers in order to meet the demands of the 1 and 2 day shipping for customers. So for example, they're building a distribution center near Iowa City, and they're building one just outside of Des Moines right now. They have one in South Minnesota, and that is so that customers within the region can receive packages quickly. Sales sustaining costs. These are the resources consumed to sustain sales that can't be traced to an individual unit, batch, customer, or distribution channel, such as our general advertising expenses from running a ad campaign in a newspaper, online, on TV, or otherwise. When we do customer profitability analysis, we're going to look at the customer revenues and costs to assess that customer profitability. Then we can identify not only actions to improve customer profitability, but which customers are the most profitable for our company. So we're more likely to try to make those customers, keep those customers happy. So some companies quantify customer value in what's called customer lifetime value, or CLV. This is equal to the net present value of all estimated future profits from the customer for a specified period of time. When we're looking at customer profitability analysis, we're asking these different kinds of questions, and I've mentioned some of these already. What is the growth potential of the customer? What's the likelihood that they're going to come to us a second time, and that the second time they come to us, they're going to buy even more of our products? What's our cross-selling potential? What kind of items do they usually buy? If they're coming to us for clothing, is it possible that we can start selling them shoes? What are the possible reactions of the customer to changes in sales terms or services? What if we have a regular customer and we have a free shipping service, and we change the terms of that service, that we no longer offer free shipping and we start charging for shipping. Is that customer going to be happy? Are they going to keep using our products and services? Or are they going to go to a company that maintains that free shipping? And how important is it to keep this customer happy? Maybe this customer has ordered from us 50 to 100 times, but they have such a low value order that we don't spend a lot of time and energy trying to make sure they bring us more money. When we're implementing activity-based costing or activity-based management, it requires a lot of cross-team cooperation. As we're trying to identify what each of these activities are, how the activities use resources, and what those proper cost drivers are of those resources, we need to get information from the people who are involved in those activities. So as the management accountant, we're gathering all of that information so we can do our cost analysis. But we have to get that information from engineers, from the manufacturing labeler, from our operating managers, so that because we don't know how many engineering hours it takes for a product or what the packaging costs are on necessarily on each product or how we should allocate resources to these activities. So when we're looking at implementing activity-based costing and or management, we need to realize that some activities are cost objects for other activities. So that's multiple stage activity-based costing. Then we also have resource consumption accounting. When we're looking at, we emphasize being able to attribute costs, both fixed and variable, to cost objects for decision-making purposes. And our time-driven activity-based costing helps us simplify some of the complexity involved in very large systems by just looking at the time that activities take. We look at these a little bit further. So for our resource consumption accounting, we know that resources are the suppliers of capacity. So our capacity to provide products and services are a function of the resources that we have available to us. If we only have one employee, that affects our capacity to offer products and services. If we have 10 employees and we run one 8-hour shift, then our capacity has increased. If we have 10 employees and we run two 8-hour shifts, that can alter our capacity. If we have 10 employees on each 8-hour shift, then we've doubled our capacity. But capacity is driven by the amount of resources we have available to us. The quantity-based model looks at the operations view of the organization, understanding that there's a causal relationship that can be expressed in terms of input and output units. This looks at that relationship between our cost drivers and our cost objects. So we're saying we can see a relationship between our resource allocations and the number of units that we're able to produce. And that the characteristics of our costs are inherent to our underlying resource and the consumption of those resources. We use those resources and cost behaviors to create value in our company and organization. Our time-driven activity-based costing is based on the idea that the common element in every activity is the unit of time. And therefore, we assign resource costs directly to our cost objects. Cost objects are our products or services, using the cost per time unit of supplying the resource. This requires our total activity cost to be divided by the number of minutes available to that activity so that we can provide a cost per unit of time. In this example, we have two workers who are paid $45,000 annually to perform an activity that is expected to require 17 minutes. We calculate their total cost as 45,000, their salary times 2 employees gives us a total cost of $90,000. We then calculate that the total time available is 180 minutes. As we can see here, that's assuming we have 30 hours per week with 2 weeks of vacation a year. So we have 2 workers times 50 weeks times 30 hours times 60 minutes per hour. That gives us 180 minutes per year to perform this activity that requires 7 minutes of time. Therefore, our rate for the activity is 50 cents per minute. Our total cost divided by the total amount of our allocation base, which is the minutes per year. So our 17-minute activity is given a rate of $8.50 based on the time it takes. That is the end of chapter 5.